Hi, and welcome to this week's market presentation. Latest news. Starting with the direction of U.S. trade policy, President Trump and his team announced a multitude of new tariffs against countries that would be set in place starting in August 1st. Most importantly are the threatened 30% tariffs on all EU imports in the US, prompting emergency talks amongst EU ministers and fears of a trade war between both blocs. EU leaders have agreed that a trade war would be a disaster for the EU economy and have vowed to try and work with the Trump administration to reach a deal before the August 1st deadline. The reaction from financial markets in particular, however, has remained very subdued, in part as markets appear to be pricing in the prospect of the US either extending the August 1st deadline or backing away from the 30% tariffs, given the prospect of significant negative economic harm to the US economy itself. More curiously, regarding a 30% tariff set on EU goods imports in the US, is the fact that the EU currently has a trade surplus with the US in goods, but a deficit in services. At the same time, a large portion of the trade deficit is due to pharmaceutical products, which are oftentimes imported from countries such as Ireland, and really done so as a matter of tax policy instead of actual physical trade. Moving on to the Russian-Ukraine war, Russia has intensified its airstrikes against Ukraine as the country faces record drone and missile strikes with a higher level of civilian casualties. The US announced today that it would be restarting military supplies to Ukraine and that it would be opening the door for Europe to purchase military equipment from the US to supply to Ukraine, potentially opening the door for additional military aid to Ukraine as it continues its fight against Russia. And then lastly, looking at the conflict in the Middle East, starting with the situation in Gaza. The conflict continues with no progress between Israel and Hamas on ceasefire talks to end the conflict peacefully. Then moving on to the situation in Iran. While Iran has stated that it is open to nuclear talks with the US, one of its key negotiating points is that there must be firm guarantees that there will be no further attacks from Israel on Iranian territory. Additionally, some positive movement with Iran stating that cooperation with the IAEA will resume, although it will take on a quote new form following the concerning reports and announcements that Tehran was formally ending cooperation with the organization earlier in July. Lastly, the Houthi rebels continue to target shipping vessels through the Red Sea, continuing to add to the limited trade going through that area, and in turn adding to the risk premiums of trade in the region. Weather. Looking at the latest weather forecast, we note above average temperatures forecasted for Europe, particularly through the middle of this week, before dissipating to some degree later on in early next week. Nonetheless, the prospect of continuing heat waves and higher temperatures across Europe continue to be a bullish factor across commodities. In terms of precipitation, we note an uptick in precipitation, particularly as we look through the beginning of next week, and in particularly across the Nordic region. Then looking at average wind speeds, we are seeing a drop in wind speeds, particularly through the middle and early of next week, leading to some bearish sentiment regarding wind power generation. Lastly, looking at the Atlantic hurricane outlook, we note a 40 to 60% chance of a cyclone or tropical storm forming off the coast of Florida. And while it remains too early to say whether it will impact US oil and gas production in the Gulf or US LNG export activity, it is certainly raising concerns of potential disruptions in the area. Microeconomics. The June 25 inflation figures were released for the euro area and China. Focusing on the euro area, we showed limited movement in inflation, with year-over-year inflation remaining at 2%, in line with the European Central Bank's target. And looking at core inflation, we saw that remained stable at 2.3%. These figures likely adding to the possibility of additional interest rate cuts this year. Crude oil and LPG. Looking at crude oil markets here, we note the continued uptick in the price level for both WTI and Brent crude across the forward markets, with prices increasing a little over 2% for both the front month and front year over the past week. The uptick in the market certainly due to some tight conditions during the summer months, given the higher temperatures and ongoing increase in demand that we are seeing in Asia, in Europe, and the Atlantic Basin in general. On the other hand, we are seeing the supply and demand balance improve later on, as we can see here, primarily driven by an improvement in the supply forecast for the remainder of the year and for 2026. Big driver of the improved supply outlook is the continued decision by OPEC Plus to increase production quotas starting next month. Natural gas. In terms of natural gas markets, here we note prices increased over the past week. The foreign quarter, for example, moving up 4.2% over the past week. Looking at the front year price, we see a further increase of 3.2% over the past week. And overall, a general upward movement over the last week. The upward movement in natural gas markets has really been driven by tighter conditions in the coming months due to the summer weather conditions, as well as the disappointing or the worse hydro power and wind power output, necessitating additional natural gas-fired power generation at times of peaking cooling demand due to the temperatures. In terms of the fundamentals, starting with storage, we see storage levels increase to just over 62% as of the end of last week. The injection rate has lowered over the last week compared to where we were just a few weeks ago. However, it does remain above last year's levels, which has helped continue to diminish the storage deficit versus a year ago, which currently stands at around 18%. In terms of the inventory level across European countries, we definitely note how Germany remains below the European average, while other neighboring countries, particularly in South and Western Europe, have seen levels above the European average. In terms of total supply and demand, we've seen total demand come down over the past week owing to the slightly cooling of temperatures following the heat wave the prior week. Then in terms of supply, we've seen a pretty stable evolution with strong Norwegian gas flows into Europe being compensated by a drop in LNG sendouts in particular. We see that more clearly here, where we see those Norwegian gas flows having improved over the last few weeks, now in line with last year's levels, while LNG sendouts have correspondingly decreased over the same period of time. Nonetheless, LNG sendouts remain near the highest levels for this time of the year. One of the reasons for the decrease in LNG sendouts has been the decrease in LNG imports into Europe, as price competition with Asia has intensified over the last couple of weeks, with LNG imports into Europe down 18% month over month. Part of the reason has been the widening price premium between Asian and European gas prices. Looking at the investment positions for TTF, we note a continued decrease in net long positions, partly due to the recent bearishness following the ceasefire announcement in the Middle East, reducing that risk premium. Coal. Coal prices have seen similar upside as natural gas, with the front year for the API2 index, for example, increasing at just under 3% over the past week. The uptick in coal prices very much represents a potential higher demand as it relates to summer demand across Europe due to the forecast of warmer temperatures. At the same time, global supplies are seeing some tightening, particularly due to a drop in exports from Indonesia. On the other hand, Import demand from China has been weaker than earlier in the year, particularly as domestic production has increased strongly, necessitating fewer imports. EU and UK emission allowances. European allowance prices had seen a slight drop over the past week of around 1.5%, while UK prices saw pretty stable evolution over the past week with rather small movements. Looking at the level of power sector emissions from Europe, we note that the level of emissions stabilized over the past week following that continued increase the previous weeks, very much driven by weather conditions and the spike in cooling demand that we saw the previous week. Nonetheless, power sector emissions remain at the bottom of the range since 2019 and in line with last year's levels. In terms of investment fund positions, we've seen a slight uptick in European allowance futures, while UK futures have come down slightly over the last few weeks, but nonetheless remain near record highs. Electricity. Looking at electricity prices here, we note the uptick in electricity prices, more notably felt for the Q4 25 and Q1 26 products, as you can see here, with increases of around 2%, while further into 2026, we see more limited gains, with the forward year increasing by just under 1% week over week. A similar price evolution can be noticed across other European countries with similar evolutions as the German power market. In terms of total demand and residual load, we've seen a drop in total grid demand, very much driven by the drop in temperatures over the last week compared to the heat wave that we saw the prior week. Overall, residual load remains at the bottom of the range since 2019 and still currently in line with last year's levels. In terms of the supply mix, we've continued to see the share of solar continue to increase as we see record high levels of solar production across Europe. On the other hand, the weaker hydropower output has seen that share come down accordingly. At the same time, the weaker wind power generation output has similarly decreased the share of wind. Looking at the supply mix, starting with nuclear, we note the sharp improvement in nuclear power generation out of France, in particular, helping push the European output closer to the average from 2019. In terms of renewable power generation, that has actually come down over the last couple of weeks, with generation over the past week dropping below the levels of last year. This has in turn led to a temporary uptick in fossil fuel power generation, particularly during the week of much higher temperatures, with overall fossil power generation still remaining near the bottom of the range since 2019. In terms of renewables, the main culprits of the weaker output have certainly been the drop in wind power generation over the past week, as well as the below average hydropower output so far this year, and the decrease in solar power that we've seen over the past week, even though it does still remain at the highest levels for this time of year. In terms of fossil and biomass generation, definitely we have seen that uptick in fossil gas power generation, very much driven by weather conditions, and seeing that differ year over year. Lastly, when we look at the price evolution for guarantees of origin, we note the bullish price evolution with further gains over the past week, most notably felt for the 2025 production year. The main driver of the bullishness have certainly been the weaker hydro and wind power output generation so far this year, reducing the overall supply of guarantees of origin and raising concerns for the supply outlook for the forward years, adding to that bullish price evolution. That covers this week's market presentation. Thank you for joining.